This Chapter 4 screencast is going to cover the closing process. The purpose of the closing process is to prepare the accounts for the next period, and this occurs after the financial statements are prepared. So after we prepared our financial statements, this would be the last thing we would do to get ready for the next accounting period. Some of the things that the closing process does, it zeroes out revenue and expense accounts so that each period's net income can be separately measured. If someone asks you how much the company made in a year, you would need to have the revenue and expense accounts start on January 1st of that year and end on December 31st so that you can answer that question. Otherwise, you'd have to be splitting up years that are all buried in accounts. So we want to keep those separate and distinct as far as revenue and expense accounts. We also want to zero out the owner withdrawal account. So we will zero that out on a regular basis, and we're going to transfer these account balances to the capital account, as you'll see. The closing process also updates the capital account balance for net income or loss and owner withdrawals, and you'll see that as we go through the process. The closing process follows the time period concept that you've read about in your book. The time period concept allows financial statements to be prepared for specific periods of time. That is helpful for a number of reasons. It allows for comparability, both against our own results from previous periods and in the future. Also allows us to compare our results to other companies if we want to benchmark companies in our industry, that sort of thing. So the revenue, expense, and owner's accounts are known as temporary accounts. They're used for a period of time and then they're zeroed out to start over the next period. And it's those temporary accounts that we're handling up here in the closing process. The revenue and expense accounts and the owner withdrawal accounts. So all those again are known as temporary accounts. And we zero them out to start over the next period. Conversely, assets, liabilities, and owner's capital accounts are known as permanent accounts. They are not closed. So we do not zero those out. In the closing process, you should not have any assets or liabilities that are closed out. You will have owner's capital accounts listed in the closing entries because you're closing temporary accounts to the owner's capital account, but you're not zeroing out that owner's capital balance. I want to give you an example of a permanent account. Hopefully it will make a little more sense. So think about your checking account. It's an example of an asset that is your asset that would not be zeroed out on December 31st. Similarly, a company is going to have a checking account that they pay their bills out of. This asset would not be zeroed out. It would not be closed out on December 31st intentionally, because if you have bills and other payments that are going to hit that account in January, if you zeroed it out on December 31st, you probably have some bounce payments and a lot of non-sufficient fund fees, and that's not a good idea, and it's not a lot of fun either. It's just expensive. So we would still have that balance on January 1st. Whatever we ended up with, if we ended up with $5,000 at the end of December 31st, no other transactions, when transactions started on January 1st, the balance would still be the same, that $5,000. It carries over to the new year. That's how permanent accounts work. We do not zero those out. We carry over those balances. So as noted before, we use the temporary account income summary to close revenue and expense accounts and to transfer balances to owner's equity. This is a really temporary account. This is all we use it for. So we will use it to close the revenue and expense accounts and to transfer to owner's equity, and then it just becomes inactive until we need it again for the next closing process. So that is the only reason we would use the income summary. So it's a really temporary account. What I'd like to do is step through the steps in the closing process and talk about those a little bit. So step one in the closing process, we zero out revenue accounts. In my example here, we're debiting service revenue $5,000 and we're crediting income summary $5,000. Now, why are we doing this? Let's think about a revenue account to begin with. What type of an account is service revenue? It's a revenue account. What's the normal balance of a revenue account? It's a credit, right? We learned that in previous chapters. Hopefully it's becoming easier as you work with this information. So the normal balance in the revenue account is going to be a credit. If we want to zero that credit balance out, what do we have to do? We have to debit it to get that balance to zero. That's why we see this debit here in service revenue. The offsetting credit, because again our debits have to equal our credits, is going to be to that income summary account. So that's step one. If we had two separate revenue accounts, say we sold computer equipment along with providing services, we would debit both of those revenue accounts, and then the total of those two would be the credit to income summary. But you would have to zero out each revenue account. My dog agrees too. So step two, we're going to zero out the expense accounts. And here's my example. I'm only using 2 expense accounts. Most companies are going to have more, and so you would see those listed down here. In this case, we've got a balance in the rent expense account of $1,500, a balance in wages expense of $1,750. And the reason I'm crediting those, because what's the normal balance in an expense account? It's a debit. So in order to zero out that debit balance, I've got to credit those accounts. The total of all those expense accounts is going to result in a debit to the income summary. Okay, again, we're zeroing out these expense accounts to the income summary. All right? Let's take a look and see what this T account of this income summary would look like. So here's my income summary, and as you probably already guessed, I'm a big fan of T accounts. I see students go through and prepare these closing entries, and if they don't prepare a T account to calculate the balance in the income summary, they often, if they just try to eyeball it, often get the numbers wrong. So I think T accounts can be really useful, and I would recommend them for this purpose in particular. So based on my entries up here, I've got a credit of $5,000 to income summary and a debit of $3,250 to income summary. You can see I've listed those here in my T account. What I'm going to do is calculate the balance, and the balance is a credit of $1,750. A good double check, and you know I like to double check my work if I can, the balance in this account should be the net income or loss on your income statement. Because remember, you've already prepared your financial statements before you prepare your closing entries. So you should know what your net income or loss is, and that should agree to what this balance in the income summary is. Because this is a credit balance, this would tell me that net income should be $1,750. I had more revenue than expenses. If I had a debit balance resulting in the income summary, that would tell me that I had more expenses than revenue, and I should see a net loss on my income summary, or on my income statement, excuse me. Step 3 of the process, we're going to zero out income summary to owner capital, and my dog got really excited about these closing entries. Okay, so on to step 3. We need to zero out the income summary to owner's capital. If we prepared a T account, we know what our balance in income summary is. And so we can bring that right down here. And why am I debiting income summary? Because I've got a credit balance up here and I need to zero it out. So again, the $1,750 is simply the $5,000 minus the $3,250 from up here in the T account. My offsetting credit's going to be to owner capital. Again, I'm closing out owner's income summary. I'm zeroing it out to the owner's capital account. So the $1,750 credit is going to go to owner's capital. Step 4, we zero out the owner's withdrawals to owner's capital. And following through my example, my owner withdrawal account, remember what's the normal balance of an owner withdrawal account? It's going to be a debit, correct? So I'm sitting with a $500 debit in this account. How do I get it zeroed out? I need to credit it $500. So that's where the $500 credit is coming from. My offsetting debit is going to be to owner's capital. Again, I'm zeroing out the withdrawal account to owner's capital. When all is said and done, another double check you can do is the balance in your owner's capital account should agree to the ending balance on your statement of owner's capital. So what you've done with all these closing entries really should parallel the information that you see in the statement of owner's capital, the statement of owner's equity. And if your numbers aren't the same, then there's been a mistake made along the way. So you want to go back and check, because your ending balance of owner's capital in your T account should equal what's on your statement of owner's equity. Okay. Another thing we do in the closing process at the end, after we've done all these closing entries and we've posted them to our general ledger, it's a good idea to prepare a post-closing trial balance. And you'll see that in your book and in the Connect materials. What a post-closing trial balance does, it lists all the permanent accounts. So it's going to list all the assets, liabilities, and owner's capital. And we pull the balances that are in those accounts at that time. And we want to make sure that the debits equal the credits. If they don't, that means that we have not closed out all of the temporary accounts. So that would tell us we need to go back and fix our work. Because we're excluding all the temporary accounts because they should be zero after we've closed everything out. So it's just a double check to make sure that that's working. Hope this has been helpful. Talk to you later.